Hello everyone, welcome back to ESENtaxa. Andrea Papito here, and in this video we are going to talk about the not domiciled tax regime in Italy, and we can compare this tax regime in 2024 with the other not dom tax regime that we have nowadays in Europe. If you're new in this channel, ESENtaxa talks about how to tax plan your future relocation in a precise country. We tax simulate your situation before I had the relocation, and we try to understand during your journey in a new country how to optimize your taxes, how to squeeze your taxes down and find unfamiliar tax schemes hidden in the law to help you pay less tax possible. We are #1 channel on Italian tax optimization, and in English language we explain through videos and through our website all the details, all the basic tax schemes that can help you to squeeze your taxes down. Now let's go back to the topic here. I want to basically give you an example of how powerful is the not dom Italian tax regime compare the other remaining tax regimes in Europe in 2024. Why I said remaining? Because nowadays Europe, all this tax discussion that we have also on YouTube among all the tax planners around here, we know very well these jurisdictions such as Ireland, UK, Malta and Cyprus, okay? They all share the same not dom tax regime. Maybe you know, maybe if you don't know what is the tax regime, it's basically if you produce income abroad, this income abroad is not taxed in any of this country unless you remit back the money in the jurisdiction, which means that you transfer, for example, the money in your foreign bank account in the local bank account in one of those countries, and only in that case you pay taxes and ordinary rates. Because not dom means not domicile tax regime. A domicile is like the place from which your original coming from, okay? The place you were born and the place that most likely you're going to be back in a certain moment of your life. So that's the concept behind, very generally speaking, the concept behind the not dom tax system. Okay, these 4 jurisdictions in Europe implement this not dom tax regime. Restrictions, different requirements, but more or less the basic template is exactly the same. And which is the basic template is that you can earn foreign income as long as you keep it outside this jurisdiction. This amount of money are tax-free. As soon as you bring them back into the jurisdiction, they will be taxed at the ordinary rates. Now, you see that this is quite uncomfortable, because if you wish to take the tax residence in one of those jurisdictions, it's because you want to live there or you must live there, and you have to use at a certain point your earnings that you have from abroad. So the remitted rule, it's a little bit uncomfortable. And moreover, in certain jurisdictions such as Malta and UK, we have thresholds such as 30,000 euro per year. And I think, if I'm not wrong, UK raised it to 7,000 euro at certain number of years that you have to pay regardless if you remit or not your money into these jurisdictions, okay? So you first pay this fee, and then if you remit your money inside the jurisdiction, then you have to basically pay the ordinary tax rate. Cyprus is a little bit more favorable, also Ireland, but they still have the problem of remitted are taxed on remitted base, okay? This is the first point. Another thing that a lot of people are not considering about this jurisdiction is that whenever you're running a business abroad, you most likely incorporate a company in a tax haven country or in a low tax jurisdiction, which means that you have a business there, you have an entity that runs a business, and somebody has to run this entity. Somebody who's running this entity? A board, an administration board. But in most of the cases, you are the only one owning the company and you are the only administrator of the company. Now, as long as you have an economical substance outside these jurisdictions, you're producing income abroad, and you can withdraw money through the dividend or pay yourself a salary as an employee of this company or as administrator of your foreign company. And if you keep the money abroad, you don't remit them back in this country, it's fine. Everything is fine. But imagine you have an online business. You are the only shareholder of this company, and you are also the administrator of this company. So you are the only one that's taking action to run the... Well, you're not producing any more income from abroad, but the company actually is running in that country, and you might see this company requalified from one of these jurisdictions as a local company and not anymore a foreign one, using the local ordinary tax rate. So this is the risk. It might be the chance that this country apply the POAM in the tax word system, which is the place of effective management. So this is another problem. So the place of effective management might screw up your setup with the not dom tax scheme. Now, it's true that I can say, okay, I have all the proof that allow me to contest any tax audit and say, look, I'm running my company abroad, even if it's an online business, because I take the flight, I go in another jurisdiction, and in that other jurisdiction, I run my company, I run my business. Fine, but keep in mind that all these jurisdictions are islands. So if you have a thunderstorm, you cannot take a flight, you cannot take your boat, and you remain stuck in this island, and you are obliged to run your business from this island. Imagine if this situation happens too often, so you don't feel like blocked in these jurisdictions. You see, you cannot move around easily in case of issues, in case of emergencies, and in case you want to prove that you always run your business abroad and make sure that you are always producing your income abroad and keep your money outside these jurisdictions. So this is another point that has to be taken into consideration, because how come the not dom is always related to islands, always this kind of jurisdiction? So we have to think about also this point. Another jurisdiction in Europe that basically adopt a sort of not dom regime is Greece. Greece also has a sort of not dom, it's improperly called not dom, tax regime that basically excludes from taxation all your foreign income in exchange of a fee of 100,000 euro, okay, per year, fixed rate. And if you bring your family members with you, you can extend this benefit to your family members, adding 20,000 euro at the top of your 100,000, okay? The good point of this tax regime, which as I said is improperly called not dom, because it's not the real not dom as the original meaning of the word, because this is coming from the Commonwealth law, basically allows you to remit money inside the country. So if you're living in Greece and you apply for this tax regime that allows you to exclude from taxation of foreign income, you are basically able to remit back this money in Greece, if you're living in Greece, if you took the tax residence in Greece. So apparently this tax scheme in Greece, it's more convenient than the original not dom scheme, as long as you are a high net worth individual, making 100,000 euro plus 20,000 in case you have a member of family, an amount of money that is nothing compared to the money that you're earning from abroad, such as €1 million. The problem of this not dom regime in Greece is that at the top of this fee, you have to also invest 500,000 euro, which is quite a lot, on bonds or on real estate. Okay? Making this tax regime a little bit expensive to apply, unless you have a real investment that you wish to do in this country, then it's fine, but you're obliged to also have these requirements, okay? What remains here, it's Italy, with his Italian non-dom regime, and also here we call it improperly domicile, because in Italy the word domicile, it's completely different thing. It's a different meaning, but just to understand more or less why a lot of tax advisors call improperly this tax regime with the same name of the original tax regimes of the not dom, because just to make you understand that also this tax regimes allows you to exclude from taxation your foreign income, because the principle behind is very similar. So also in Italy with the no dom regime, you can exclude from taxation all your foreign income in exchange of paying, also in Italy, 100,000 euro per year, fixed rate, and 25,000 euro for each family members. But in Italy you can extend the family members up to the third degree. So your nephew, your 3/3 cousin, so it's very, very wide, the possibility to apply this tax regime. But Italy doesn't ask you to pay 500,000 euro. So you simply have to opt for this regime in your tax file return. Okay, so if you consider that 100,000 euro is a very small amount of money to pay, compare your income, your foreign income, you can apply this tax regime, which is more convenient than the Greek one. At the top of it, also in Italy, you don't have the remitted basic issue, so you can basically bring your money in Italy, and those money are not subject to ordinary Italian taxation. As long as you don't produce income in Italy, otherwise you will be taxed at the ordinary Italian tax bracket system. Also in Greece it's exactly the same. You won't pay any taxes from everything. It seems that for Greece we understand clearly why it's more advantageous. But compare the other not dom, we have the advantage that we can remit the money inside Italian territory, it's fine. But one of the things that I have just mentioned before is that these jurisdictions are islands. And in case you running your business, an online business, you are the only one that provides the place of effective managers of the business, this jurisdiction might qualify this business as a local one. Also, Italy does the same. But the difference is quite in the distances and quite in the borders. Why? Because Italy is not an island. Italy is surrounded by France, Slovenia, Austria, Switzerland, and Republic of San Marino, which are jurisdictions that shares the borders with Italy, which means that easily you can find a place in Italy where you can set up your residence, you can choose the municipality of choice in Italy, close to the border, and run your business easily in few kilometers away in a different office, in a different jurisdiction. And your business will be never qualified as an Italian one. You can run your foreign business outside Italy, the income is produced abroad, and Italy never qualify your foreign company as an Italian company, and your foreign income remains as dividend from abroad, as the administrator salary from abroad, and everything runs smoothly. Moreover, you don't need to have a minimum physically presence test in Italy, as you must have in all these jurisdictions, for example. But Italy doesn't require you to stay physically in the territory. In order to be tax resident in Italy and apply for this not-dom regime, which is basically also known as a new resident fixed tax or flat tax for high net worth individual, it requires you just to have your name registered in the municipality for more than 183 days, okay? Which means that once your name, your registration in the commune stays for more than 183 days per year, per tax year, you are automatically considered tax resident in Italy and can apply this tax regime. And you have the tax certificate from Italian jurisdiction in case you need to contest some tax audit and some other tax residents against other foreign countries. Also, this is possible. So this is the trick. You can register your name in Italian territory, you can apply this tax regime, pay this fee and exclude from taxation everything coming from abroad. Also, you don't need to monitor your foreign asset. And you can also basically run your business abroad, stay abroad more than 6 months. You can stay abroad more than 6 months, as long as your name remains there. So I just want to make this video just to help you to think about it. Think about the 2024 year. We might have some changes from jurisdictions in Europe. As I said at the beginning of the video, the European Union is putting pressure to the European Union jurisdictions to avoid unfair concurrencies tax systems among the European countries. Those are the best tax regimes still left untouched for the next year. So, if you want to know more about how to strategically use this tax regime for your specific situation, just let us know. In the description below the video you will have our email contact, info@esentaxa.com, or you can straight book a call with us. You can check in the Calendly link in the description below this video the length of your call, and we can discuss this tax strategy and help you to better relocate in a specific jurisdiction based on your personal situation and allows you to pay less tax possible. Thank you for watching this video. See you to the next content. Bye.